It begins not with a bang, but with a message on a screen. You are standing in the vestibule of your local bank branch on a Tuesday evening. The glass doors are locked, the lights are dimmed, and the only illumination comes from the glow of the ATM. You need $500. Maybe it's for a contractor who offers a cash discount. Maybe it's for a used car. Or maybe you just feel safer having physical currency in your pocket during uncertain times. You insert your card, you punch in your PIN, you select withdrawal, and then the machine pauses. It whirs for a second longer than usual, and then the screen flashes, temporarily unavailable, or perhaps daily withdrawal, limit exceeded, even though you haven't touched your account in a week. You feel a twinge of annoyance. You think it's a glitch. You think the machine is out of 20s, so you drive to the next branch. Same message, you try a third one. This time, it lets you take out $100 but denies the rest. Suddenly, the annoyance turns into something colder, something heavier. It turns into fear. You realize, standing there in the cold night air, that the money in that machine does not belong to you. It belongs to the bank. And right now, the bank is deciding that you cannot have it. Welcome back to the channel. In our last report, we exposed the silent cut, the secret strategy banks are using to slash your credit limits and freeze your borrowing power. But today, we are going to talk about something far more terrifying. We are going to talk about what happens when they come for the money you already have. We are witnessing the beginning of the Great Deposit Freeze. Across Canada, a quiet wall is being erected between you and your savings. Withdrawal limits are being lowered. Cash is becoming harder to find, and buried deep in the Canadian legal code is a mechanism that allows the banks to confiscate your deposits to save themselves from bankruptcy. It is called the bail-in, and if you think your money is safe because it is in a systemically important bank, you are walking into a trap that was set years ago, waiting for this exact moment to be sprung. To understand why your money is trapped, you have to understand the lie that is the foundation of the modern banking system. We grow up believing that a bank is a vault. We imagine that when we deposit $1,000, that money sits in a safe box with our name on it, and waiting for us to come back and claim it. But that is a fairy tale. When you deposit money into a bank, you are not storing it. You are lending it. Legally, the moment that cash crosses the counter, it ceases to be your property. It becomes the property of the bank. In exchange, the bank gives you an IOU, a digital promise to pay you back if they have the funds available. But here's the catch. They don't have the funds. The Canadian banking system, like all modern banking systems, operates on fractional reserve. They are only required to keep a tiny fraction of total deposits on hand. They lend the rest out. They use your savings to fund mortgages for overpriced condos in Toronto. They use it to issue commercial loans for office towers that are now sitting empty. They gamble with it in the derivatives market. Well, for every dollar you see on your screen, the bank might only have a few pennies of actual liquidity. This system works fine when everyone is calm, but when people get scared, when everyone rushes to the door at once to redeem those I owe us, the illusion shatters instantly. The vault is empty, and right now, the banks are terrified. They know what is coming. They are looking at their loan books and seeing a disaster. The commercial real estate market is collapsing. The mortgage renewal wall of 2026 is approaching, promising a wave of defaults from homeowners who can't afford 6% interest rates. The banks are technically insolvent if they were forced to liquidate their assets today. They are bleeding liquidity, and when an animal bleeds, its instinct is to conserve energy. For a bank, that means hoarding cash. It means making sure that money flows in, but it does not flow out. This is why you are seeing the soft restrictions first. Have you tried to withdraw a significant amount of cash from a teller lately? Go to your branch tomorrow and ask for $5,000. Watch the reaction. They will look at you with suspicion. They will ask you what the money is for, intruding on your privacy. Then they will likely tell you that they don't keep that much cash on site. They will tell you that you need to order it a week in advance. Think about the insanity of that statement. A multi-billion-dollar financial institution doesn't have $5,000 on hand. It is a lie. They have the money. They just don't want to give it to you. They are erecting friction barriers. They want to make it so difficult, so inconvenient, and so awkward to withdraw your capital that you just give up and leave it in the digital system. But why are they so desperate to keep you digital? Because as long as your money is a pixel on a screen, they control it. They can freeze it, they can limit it, and most importantly, they can bail it in. Let's talk about the bail-in. This is the gun aimed at the head of every depositor in Canada, and almost nobody knows it exists. After the 2008 financial crisis, governments around the world, including Canada, decided that they could never again use taxpayer money to bail out failing banks. It was political suicide, so they came up with a new solution. Instead of a bailout, they created the bail-in. In 2018, the Canadian government formalized this regime. Under the bail-in framework, if a major bank is on the verge of failure, the government does not write them a check. Instead, the bank is given the legal authority to take its own debt obligations and convert them into equity. In plain English, they can take the money they owe to bondholders and certain depositors, and instead of paying it back, they tear up the IOU and give you worthless stock in the failing bank. You might be thinking, but my deposits are insured by the CDIC. I'm safe up to $100,000. And on paper, that is true. But there are gaping holes in that safety net. First, the CDIC, the Canada Deposit Insurance Corporation, only has a reserve fund that represents a tiny fraction of the total insured deposits in Canada. If a massive bank like RBC or TD were to collapse, the CDIC would be overwhelmed in minutes. It is like trying to put out a forest fire with a garden hose. Second, the bail-in regime is designed to happen before a total collapse to keep the bank operating. It creates a gray zone where your access to funds could be frozen while the restructuring takes place. This is the true meaning of your money is trapped. It's not just about an ATM limit, it is about the legal transformation of your savings into the bank's emergency survival fund. Now, let's connect this to the broader war on cash. Why are banks closing branches at a record pace? Why are they removing ATMs from rural areas? Why are they pushing cashless payment methods so aggressively? It is not for your convenience, it is for their control. Physical cash is the only form of financial freedom left. It is the only way to transact outside of the surveillance grid. It is the only form of wealth that cannot be turned off by a switch or seized by an algorithm. When you hold a $100 bill, you hold a bearer asset. You own it. When you have $100 in your bank account, you have a permission slip. The banks know that if a panic starts, a true bank run, they cannot survive it. In the digital age, a bank run doesn't look like a line of people around the block. It happens on smartphones. It happens in seconds. We saw this with Silicon Valley Bank in the US. Billions of dollars were moved in hours. To prevent this digital bank run, the banks are quietly implementing velocity limits. They are setting caps on how much you can transfer out per day. They are flagging large transfers for security reviews that can take days to clear. They are slowing down the exit doors. If you try to move your life savings to a credit union or to a crypto wallet tomorrow, you will likely find your account locked for suspicious activity. You will spend hours on the phone with a fraud department pleading to move your own money. This is the soft freeze. It is designed to buy them time. But what happens when the panic becomes real? What happens when the news breaks that a major Canadian developer has defaulted on a $1 billion loan and a big bank is taking a massive hit? That is when the hard freeze begins. Imagine waking up to a notification. Due to market volatility, temporary withdrawal limits have been placed on all accounts. Suddenly, you can only take out $50. Suddenly, your debit card doesn't work at the gas station. Suddenly, your pre-authorized payments for your mortgage and hydro bill are bouncing. Not because you don't have the money, but because the bank won't release it. This creates a chaotic feedback loop. The inability to access money causes more panic. People rush to the few remaining ATMs, draining them in minutes. The velocity of money crashes to zero. The economy grinds to a halt, and in that moment of crisis, the government will step in. But they won't step in to give you cash. They will step in to introduce the solution they have been preparing for years. Central Bank Digital Currency, or CBDC. This is the ultimate trap. They will offer to unlock your frozen funds, but only if you convert them into the new digital dollar. This new money will be programmable. It will have rules. It might have an expiry date to force you to spend it. It might be restricted so you can't buy certain items. It will be the end of financial privacy and the end of financial autonomy. The bail-in and the liquidity crisis are the manufactured crises that will be used to usher in this new system. They need the old system to break, or appear to break, so they can force you into the new digital pen. We must also look at the commercial real estate disaster that is driving this. The Canadian banks are heavily exposed to the housing market, yes, but their exposure to commercial office space is the silent killer. Vacancy rates in Toronto and Montreal are at historic highs. These buildings are worth a fraction of what they were financed for. The loans are coming due, and the landlords cannot pay. The banks are extending and pretending, refusing to mark these losses on their books because if they did, their capital ratios would collapse. They are zombie banks walking dead, kept alive only by the confidence of the public. But that confidence is eroding. Smart money is already leaving. You see it in the capital flight. Wealthy Canadians and corporations are moving money into U.S. treasuries, into gold, into assets that are outside the Canadian banking blast radius. They know that when the ship goes down, the steerage passengers, the average depositors, are the ones who get locked behind the gates while the lifeboats launch. So, what does a bank run look like in 2026? It looks like a glitch. It looks like a system maintenance message that lasts for 3 days. It looks like a customer service line that simply rings busy. The banks will not announce they are insolvent. They will blame hackers. They will blame a software update. They will blame a power outage. They will use every excuse to deny you access while they frantically try to restructure their debts behind closed doors using your money. And if you think the government will save you, look at how they handled the trucker protests. They froze bank accounts without a court order. They weaponized the banking system against their own citizens for political dissent. That was the test run. That was them showing you that your money is only yours if you behave, and if the system allows it. The precedent has been set. Financial seizure is now a tool of statecraft in Canada. This brings us back to the concept of you will own nothing. If your money is in the bank, you don't own it. If your house is mortgaged, you don't own it. If your car is leased, you don't own it. You are a user, a renter, a dependent. And dependents are vulnerable. The goal of the financial elite is to strip away your independence. By trapping your liquidity, they strip away your ability to react, to move, to escape. So, what can you do? The window is closing, but it is not shut yet. First, you must understand that diversification is no longer just an investment strategy. It is a survival strategy. You cannot have 100% of your liquid net worth in a single Canadian bank. You need to spread your exposure. Look at credit unions. While they are still part of the financial system, they are often less exposed to the massive toxic derivatives and commercial loans that the big banks hold. They are structurally different. Second, you need to be your own central bank. This means holding physical cash. I am not telling you to pull everything out and stuff it in a mattress. That is dangerous and impractical, but you should have enough cash on hand to survive for 1 to 3 months if the banking system goes dark. If the ATMs stop working for a week, how will you buy food? How will you buy gas? Cash is the ultimate hedge against a digital freeze. Third, look at real assets. Gold and silver are the enemies of the banking system because they are money that has no counterparty risk. When you hold a gold coin, you don't need a bank to validate its value. You don't need an internet connection to spend it. It is wealth that exists outside the digital trap. Fourth, pay attention to the warning signs. If you see your bank suddenly offering unusually high interest rates on GICs or deposits, be careful. That is often a sign of a desperate need for liquidity. If you see more technical outages, take note. These are the tremors before the earthquake. The bail-in is not a theory, it is the law. The liquidity crisis is not a grim prophecy. It is a mathematical certainty given the state of the real estate market. The limit on your withdrawals is not a glitch, it is a policy. The banks are preparing for the storm. They are boarding up their windows with your money. Do not be the last person in line when the doors lock. Do not let your life savings become the collateral damage of a broken financial system. The trap has been set. The mechanism is armed, and the hand hovering over the button is not yours. Check your accounts, test your liquidity, and remember, if you can't hold it, you don't own it. Stay vigilant, stay liquid, and do not let them trap you. I will be monitoring the insolvency data closely in the coming weeks. Subscribe and turn on alerts because the mainstream news will not tell you the bank is failing until it is already too late. Protect your wealth, and I'll see you on the other side.